everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. As I mentioned, we have been doing this for 4.5 years. It's amazing. We've made amazing relationships with all types of investors. But you know what? I work for Old Capital Lending, and we are a premier provider of debt in the multifamily space. That's where we spend about 95% of our time is in multifamily. The rest of it is in the other asset classes, and you know all of those. So if you are looking at a deal right now, I would love the opportunity to become your premier provider, and all we'll need is your T12, your rent roll, the OM, and your underwriting. And we can give you a high level based on those financials where you need where the debt is going to come in and where maybe you need to be pricing these deals. Tonight, I am just delighted to have Ken McElroy here. Ken McElroy is a renowned American entrepreneur, CEO of MC Properties, and a real estate expert. He's his best-selling author of 6 books on real estate and entrepreneurship, includes the ABCs of real estate investing. Ken is a trusted advisor to Robert Kiyosaki of the Rich Dad Company. His career began when he managed an apartment complex in college, which sparked his passion for real estate. He founded McElroy Management, later merging it into MC Companies, which manages over 3 billion, that's B with a B billion, in real estate, and aims to oversee 25,000 units by 2029. Ken McElroy is an influential figure on social media with a popular YouTube channel and podcast. He actively engages with his audience and continues to share his insight. Beyond his professional life, Ken serves on the board of directors at the Southwest Autism Research and Resource Center and resides in Scottsdale, Arizona with his family. So without further ado, I am excited for this live conversation tonight with our industry expert, Ken McElroy. Ken, welcome to Zoom at 8. How are you?
Thanks, Julie. I appreciate being here, especially with like-minded folks. This is awesome when you have real estate investors on the actual Zoom. So I'm excited for tonight.
It is going to be wonderful. If you have very little experience tonight or you have lots and lots of experience, Ken is going to be able to touch something for everybody tonight. So if you guys would do me a great favor, go to the top of your right hand of your computer and go to speaker view. You're going to see me. Hello, everybody. But once Ken gets started, we're going to see Ken live in person. So Ken, I want to start out first. New people in the room. You know, you wrote this amazing book, ABCs of Real Estate Investing. I read it probably 5 or 6 years ago, loved it, found it extremely helpful, even though I have 30 years of experience. So everybody can take something from this book. And one of the things that I wanted you to talk about for the new people is really the 5 tips to invest like a pro. You know, you talk about it. You've got 5 different tips: how to set goals, how to stick with an investment criteria and how you understand it, how to diversify your market, a roadmap to your investment strategy, and cash flow versus capital gains. Can you give us some insight on those 5 tips? We'd love to understand why each one is so important to building and investing as a pro.
Sure. Yeah, I'm happy to. I think that also I would love to take some Q&A if we could,
Sure.
maybe toward the end. I actually really enjoy that a lot. Just a real brief history. I'm from the Seattle area. I grew up there. Started with one single family, just like probably a lot of people. And then that just eventually grew into bigger stuff. And then eventually I started buying multifamilies. And somewhere along the line, that's when I met Robert Kiyosaki. I was raising money, just like you guys raised money. For me, he was just another person that was going to invest as an LP. I had no idea who he was because he had just written Rich Dad Poor Dad, so it was 20 some years ago, and it was not the phenomenon that it is now. But and he said, "Hey, why don't you come to one of my seminars?" Which I actually hadn't gone to hardly any real estate seminars at that point. And I realized how much I enjoyed teaching, and that was it for me. I started, kind of hooking up with Robert and going on and touring with him a little bit, and then he asked me to write the books, which I did do. All the books go to charity. We have a full-time director of philanthropy in our company. We hired her about 6-7 years ago. So I do this stuff. I really teach this stuff because I really enjoy it. It's true. We do have, right now we have about 2 billion in assets under management. We bought 3. Part of the philosophy is exiting as well. But I don't know how you guys came up through the business, but I didn't know much. I didn't know how to hire CMOs or CFOs or COOs or CEOs or CIOs or any of the C's. I didn't know anything about that. But I just figured it out. And so now, of course, we got 300 people, and we do construction, development, and acquisitions. And we currently have just over 9,000 units, I think, at the moment. We've got 6 under construction, or actually 2 under construction, 4 in pre-development, 1 in escrow right now, like a 250 unit. And I'm also buying a billboard company at the moment, which we can talk about if you like. So I own some billboards too, because they're really good passive income. So, and then what happened was I ended up, when we all got sent home during the pandemic, I started the YouTube channel, and I didn't quite realize, where we go and what end up doing. So that's when we started the podcast and stuff like that, which is really, really, really fun for me. But really, I spend 95% of my time finding properties, working with our acquisitions, our analysts, property management company, all that stuff is really where I spend most of my time. So I'm excited to be here. Julie, thank you. I think so. The first thing, obviously, what I found when I first started to figure out what I wanted to do, I'm talking about for real estate. I knew I wanted to do real estate. There's a lot of deal flow that comes at you. We get hundreds a week, literally. I'm not kidding when I say hundreds a week, literally hundreds a week from all over, because you want to get on as many lists as you can. And we're on as many lists as we can. So, one person can't filter that, but now we have people filtering that. But I think when you figure out what your buy box is, whatever that is, I think everything becomes a lot clearer, because otherwise what happens is sometimes you go chasing your tail. All kinds of stuff comes up. Broken deals in little cities that we've never been to, and so it's all, as a real estate investors, it's super hard to stay disciplined. And so when I was talking about setting goals as being number one, I think it's important to really be an expert in whatever it is you want to be an expert in, because I've tried, trust me, I've been in all kinds of stuff. We've done, single family, we've done customs homes, we've done self-storage, we've done office, we've done multifamily. I'm not saying you shouldn't do all those things. I'm not saying they're not good deals or they can't be good deals. I'm saying that when we decided to just hunker down and be really, really good at multifamily, it was easier to build a team for that. And it was easier to scale, and it was easier to get everybody's on board, with that vision. So once we decided to buy just 200 units and up, and we got 2 things going at once. So we have our construction company that buys land and builds properties that are Class A, obviously, because it's hard to build anything other than Class A. And then we also try to do value add, although that space is pretty cooked, I would say, from the last 10 years. But we've been doing this. This is our 22nd year in business, and that's been our philosophy. So when the Class A existing product gets too high, we build. And so, you know, it always just kind of goes back and forth. And the other interesting thing is we are primarily holders of real estate. And I think that that is contrary to most people. Most people are buying, turning, and you know, exiting. And we're going to kind of get to that in a minute. I obviously, in my early days, when I was in my late 20s, early 30s, I did that. I was doing condo conversions. I was buying properties, fixing them, turning them, and I made a lot of money. And that's actually kind of what set my base. But I paid a lot of tax. And at the end of it all, I was like, I didn't own anything. You know, when you buy something, sell it, you don't own anything again. You got to go do it again. So the reward for a big job or a good job is a bigger job. So, you know, so that's when we decided 20 years ago, I'm not going to do that anymore. I'm just going to take the long, slow road of passive income and use the tax advantages and all those kinds of things. That all of a sudden, what it does is it attracts a very different investor. So most of our investors have tax problems. You know, they're not institutions. So I have done plenty of stuff with institutions and there's nothing wrong with them. But they have a lifespan on their money, on their equity. They want their money back as you would want your money back. So when they give it to you or me or whoever, you know, it's on a 3-4 year time frame. That's it. So if you're getting equity that way, debt, of course, is a little bit different. But, you know, so what happens is that equity doesn't always line up with the property or the market. So you can pick the right market, you can pick the right property, and then you start your plan. Well, if your plan doesn't go right to business plan and it's not exactly in sync with where you want it, you could find yourself on the other side of the equity, and them saying, hey, we want out. And then you would have to sell below market or whatever. So I found that just going to the LP model, which it sounds like a lot of people here are on, is much better because my LPs, they want the passive income, they want the tax benefits, and these are things that go into their estate planning and get passed on to their kids and things like that. And you know, so I really just want to focus. That's kind of the cash flow versus capital gain mindset. Now there is a time to do capital gain, and we've done plenty of it. So, but it has to be strategic, and you got to kind of have your base. You know, with that, Julie, did you have any questions on regard to what I just said?
No, you had all of the reasons or the 5 pieces to all of that. That is terrific. You know, Old Capital coined survive to 25. You know, we're all in this right now, trying to figure out what are we doing? Are we going to be able to take on assets? Kind of a reset, right? We've seen so many people get into this market over the last 3 years, people that didn't necessarily know what they were doing. So how are you looking at this reset? How are you looking at this time to kind of gather your thoughts, kind of gather how you're managing your existing assets, as well as what's up ahead for the next 6 months, the next year, on how you're going to maybe go at these differently, with inflation? How's that playing into how you're looking at deals, the interest rates, going up 11 times, consumer spending, the raise in rates for, just auto, homes, all of that. How are you resetting, looking at the market today?
Sure. So I think, like when I started my business, I was just trying to survive and keep the lights on and all that kind of stuff. And thankfully that worked. Then what happens is you start to develop an incredible confidence and trust with your investors. So, we have investors that are 20 plus years now. So obviously, as you would. And so what happens after a while, you can imagine that, everything that we've bought over the years is worth so much more, and because we're long-term holders. So the real issue that we faced when we started to see these rates go up, and even before that, really, when a lot of people started jumping in and buying at the low number, at the call it the 3%, let's just say, that inflated the bubble more. So, so you have the same rents, you're paying more, your returns are gonna be less, right? So all things being equal. So what actually has to happen, what had to happen for us is that we had to be diligent and stay true to our discipline, which is the cash flow for the investor can never be compromised. And so, okay, and so what does that mean? What that means is every Tuesday we have our investment committee meeting, and we have 7 people on it, and we have our CIO on it, and our acquisitions team, and our analysts, and all that stuff. And they looked at all kinds of deals, and they present me a whole list of stuff that's in the pipe, and then the stuff they've underwritten, the stuff they want to make offers on, and all that. So we have a whole process. You can imagine for almost 2 years, being them, not me, I'm saying no, 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 no. After all that work, okay, that can be super frustrating for a staff. And you know what's at risk for me? 18 years or 20 years and all my investor relations, all of that. So, we haven't really bought very much in the last 2 years. We bought 2 projects, like 500 units, one in Dallas and one in Arizona, Phoenix, and those cash flowed. So I have the exact same formula that I had when I started the business. It hasn't changed. And when people started paying more, this is before rates went up. We were in the top 3, let's say, in a bid war. There might be 20, 30, let's say, groups. Then we were in the middle, and then we're toward the end, because what was happening, people were bidding $1 million, $2 million more. And the difference is, I'm not saying that they did anything wrong. I'm just saying it didn't work for me. I've solved a cash flow every time. And when I saw the market change, this is before the rent increases. The market changed because people started reaching for deals because of the cheap money, and they had a capital gain philosophy. So in other words, their philosophy was, I'm going to buy this for 20 million and I'm going to make it worth 25. And I'm going to do it because the rents are under, and I'm going to refinance it and all that kind of stuff. Okay. Well, that can work. It's basically like flipping a house. Essentially. There's really no different. There's more moving parts. So, and then it only works if the cap rates stay the same, the interest rates stay the same, the expenses stay the same, the rents stay the same. Okay, so we just pulled out of that game for the last couple of years, and normally we would normally have been buying 1,000 to 1,500, 2,000 units during that period of time. So, but we just put on the shelf, and what we did is we focused on operations. We focused on our management company, which I have in-house. So we have about 250 people in that company. And so we just dug into operations. And so I guess the knife in the side was the interest rate increases. So you had all of that. And then what happened was you had the 11 rate increases. All that did was put all those folks that could raise money online, but didn't understand the fundamentals, the operations, and all that kind of stuff at risk, and all their LPs at risk. And so those are some of the stories that you're starting to see today. Now, the cool part is I've been in this situation before in 2005. So I was buying in, but let's see, a 230 unit in Austin, Texas, I bought in 2005. Okay, with exactly that plan. And then, the bottom fell out of the economy and all, we know the story, what happened in 7, 8, 9. Okay. So what I had to do was hold that property during that period of time. There's what saved my butt was that it cash flowed on the day I bought it, and it cash flowed a year later, 2 years later, 3 years later, 4 years later. Okay. And so that's what saved me. The value for sure did not go up like I thought, but the operations, the cash flow, all that stuff saved my butt. Okay. Then eventually Austin, took off after that, as we all know. But who knows, I never knew that was going to happen. So, we just held. But what saved us was we had adequate reserves, adequate cash, great management, and we cash flowed. And so, and that was a different time. So, we don't have to go down that road too far. But that, I think, is what's going to be a problem for people today, because what they're facing today is that, people say, do interest rates and cap rates, do they correlate? Are they the same? Are they affected? And there's this long-standing debate over that topic. Well, here's what I say. It doesn't really matter. The bottom line is, as rates go up, the buyers pay less, period. Based all things being equal, right? But period. So buyers are going to pay less because their cash flow is going down because the cost of debt's up. So that alone is going to lower over time the pricing. And sellers are going to have to lower their prices if they need to exit or want to exit. And so really what's happened in the last couple of years is that the stakes have changed. Before we were beholden to the sellers. That's completely changed now. So it's just shifted back. That's all. It's not a big deal. And this is why we're buying again, is because, as Julie, in order to get a deal, I was having to put $500,000 up non-refundable before I even got into due diligence. That's how crazy, that's the equivalent of 10, 20 people lining up for a single family house and overbidding. It's the same thing. So, you got to look at these signs and then just, have the wisdom to back off and not put your money or anybody else's money at risk. And so, so we love what's happening right now. We love the correction. We think it's needed. And if you really look historically, interest rates are about historical numbers, and cap rates are too. So my whole career was built on what we're seeing today. The last 5, 6 years was a gift. But if you started in the last 5 or 6 years, you think that, things are going to hell here, but they're not. It's just, things are just going to get repriced.
Okay. So you only bought a couple properties over the last couple of years.
Yeah.
Not using bridge lending. Always stay with the agency. Is that kind of your thought process, or would you be open to bridge financing?
We definitely got into some bridge. So we,
Okay.
I'm not saying that we didn't, do some of the same things, but, I bought rate caps on every single thing I had. I had huge reserves on single thing I had. The difference, of course, is the equity or the debt. So my equity, of course, is high net worth LPs. So, I just send a letter to them and say, hey guys, this is not a time, this is not the time we want to try to exit. Right. So, and they're good, but you can't do that to a big family office or private equity or institutional equity or whatever. They're going to say, sorry, but, we're not going to ride the ship with you. We need to take our cash, take the losses, et cetera. So, and then the other one, of course, is debt. And that is, does your debt mature during those periods? And, and so as long as you have that stuff covered, it's just, we're playing the long game, just like I did. That's why I told the 2005 story. The market could change, things can change. You know, the fundamentals of property management and occupancy and all that stuff are still incredible, extremely good. So even though all the people are saying right now that you know, vacancy or rent growth is down and all that stuff, and it definitely is. It's just decelerating, but it's still positive. And I've been in markets where there's been 3 months free on a 1-year lease, you know. So I've been through all this before. This does not scare me at all. Having lower rent growth is not you know, the end of the world.
Fantastic. Now, are you underwriting differently today than you were 20 years ago? Have you
Well, yeah,
changed your metrics
yeah.
differently?
Not really on the income and expenses too much,
Okay,
although we're getting whacked with property taxes and insurance, as you know.
right.
So,
Absolutely.
you know, we had a 30%, I think our premiums are somewhere between 3 and 4 million for insurance. And we had a 30% increase. So, you know, we negotiated the heck out of that. You know, that's something that people didn't anticipate. And then I think property taxes personally are going to be next. So other than those two things, everything's kind of, you know, in the same kind of box, in my opinion. You know, vacancy, rent growth. I've always underwritten, you know, 1 to 3% rent growth a year.
Mm,
If somebody's underwriting 6, 7, 8, 9, you know, you know, that's a pipe dream. That, you know, I've seen that a few times in my career, not very much. It has happened more often, you know, in the last 5 years, but that's not normal. So we always underwrite that way. The big wild card is debt, you know, and that's your
yep.
you know, that's your bailiwick. It's you know, when you get into escrow, you know, and it's tough when debt moves, you know, when your debt. So you're right. When I heard you say in the beginning, you got to get a term sheet and loan sheet and all that stuff. It's true. You absolutely need to do that. We always do that. However, it never means anything 30 days later, right? So it moves too. So the one variable for us has always been the debt. You know, the Fed meets tomorrow, right?
Yeah.
So, you know, I don't know what they're going to do. It doesn't really matter. The markets will react, and then it'll change it positively or negatively, and then that'll change your deal. You know, and so that's kind of the big wild card for us. It's normally it's operations, it's overbuilding, it's, you know, that kind of stuff, buying vacancies, you know, rent value adds and stuff like that. Right now, those are the big three, in my opinion: the property taxes, insurance, and debt.
Yeah. Now, you talked a little bit about how it's no longer a seller's market, it's a buyer's market. And so we're starting to hear and see how the PSAs are reacting to the seller keeping their foot on the gas. Have you started to add any of your own thoughts and ideas as to, hey, I'm not paying, I'm going to ask for a reduction in price if I'm not at, 95%, my NOI goes down significantly. Are you starting to see any of that in your PSAs, just so that, listen,
Yeah.
if you're not playing the game right, I'm not losing out. So
Well,
how are you
well,
looking
again,
at that?
yeah, it's a great question. I'll tell you what we've done. I'll give you a great story. This just happened a month ago. We bid on a property. It was 112 million. We bid, and we were somewhere in the middle, I would say. I can't remember exactly, but let's just say in the middle. And the brokers are like, "Hey, you got to come up." Da, da, da. We're like, "Nope, that's our number." And it's a beautiful project. It was built a couple of years ago, and again, we're buying it below replacement cost, which is why, you know, we're buying it. You know, so I think we're in the 285, 290 a door range, which in Arizona is below what you can build it for today,
Okay.
because we're also building. So I do know those costs. So anyway, we don't get the deal. We move on to the next deal, just like we do every week. And it just closed last week for 112. And so of course we're like, you know, what happened? And I had our acquisition guy go talk to the broker, and they got retraded 3 times. And it ended up settling at 112. Now, I'm not saying that, that's just a great story for us, I'm not saying that we nail that every time. What I'm saying though is there are retrades happening right now in the market. People are locking stuff up and retrading and retrading and retrading, and they can do that now because the deposit money is refundable. 2 years ago, it wasn't refundable.
Right.
When you have 500 grand up or $1 million up, which is what was going on, and then you go to the seller and say, hey, you need new roofs. They're like, we don't care.
Yeah.
You got to close, and that's now a cost. So, and that was part of what freaked me out before when I was telling you we weren't bidding is, the money that, that gets put up, it's my money, you know what I mean? Like, I don't want to lose $500,000 on a deposit, before we even get a chance to look at a project. I think that's ridiculous. So, so you could call us conservative or whatever, but we said, listen, we got 20 years of doing it this way. We're just going to keep doing this way. So there's definitely retrading going on right now. I'm not seeing any non-refundable money in escrow out of day one. I'm seeing longer due diligences, and also I'm seeing those financing clauses really jump up now, which weren't really as much of a big deal. It was, you've been in this business a long time. Financing was just something that you did, like,
Right.
and you were always kind of close to whatever you thought it was going to be. When you're doing your rate lock and all that. But the financing is a big wild card. It can really move the needle, and also underwriters are really looking deeper now. So they're doing lower loan to values, and they're more reserves, and they're really digging. So we're in escrow on a property right now. It's 70 million, and it's 2022 construction. And it's like 200 and some units. And I was like, the rent roll or the broker and the property manager and all that stuff said, oh, yeah, we haven't done any concessions or anything like that. Okay. And I'm not too worried about that because it's a brand new project and they're leasing up. But that's what they said. So Fannie and Freddie, we put our bids out. Well, then they find that, they find, like the property manager and the seller was, doing all kinds of concessions to lease the property up. And that's not what they represented to us when we bought it. Okay. So do I still want the property? Of course. But now I have a financing problem, right?
Absolutely.
And it's a problem that the seller and the property manager created. If they would have just told us on the front end, we could have handled it, but they didn't. And so now, of course, so the underwriters are really starting to dig into stuff, which they should do. And so now we're having to overcome that because I still want the property. It's a heck of a nice property. We got it for a good price. I'm excited about the returns and all that kind of stuff. But that came out, during the underwriting. So those are the kinds of things that we're starting to see more and more now.
Yeah, I'm getting a lot of that feedback as well. So distributions, a lot of people here are investors. They're getting phone calls from their general partners saying, hey, we're not paying any distributions. In fact, can you give us a couple 50,000, 100,000 in capital calls? How are you seeing your market? How are you seeing, especially in Phoenix? I mean, we're hearing that there's a lot of new construction coming up there. There's not the rent growth that is there. How are you taking care of your investors and, taking care of their money, not necessarily doing distributions at this time? How are
Sure.
you how you managing that?
Yeah, I think that there's a bunch of things at play here. Number one is there needs to be some transparency about what the property's worth. And really the struggles they're going on with the GP themselves, right? So we'll just pick on the office building market right now, right?
Yeah.
If a property's, 40% vacant, right? They're not paying the debt and the expenses, period, right? Okay. So it's going to be worth less for the next person. So the only reason I bring that up first is because you could be throwing good money after bad. In other words, what's the property really worth? And does it really matter today what it's worth? Because if it's a 2, 3, 4 year, 5 year project that you're going to hold for a while, it might be fine. There's nothing. Properties go up and down when you hold them. So the big question is if you give them 50 or 100 today, is that going to just get them one more year of a rate cap, or is that, what is that actually going to get them? Is that going to give them 3 or 4 months of dry powder, just to pay property taxes, insurance? And so you have to dig a little bit deeper about the source of the money. And I think that's really important because it can be all kinds of things. It doesn't mean that these are bad operators or bad syndicators or anything like that. Not at all. But you got to take a look at, fiscally, are you giving good money after bad? Is the property eventually going to be lost or not? And if it is, you're done anyway. So, or is it worth, and what are you going to get for that? Right. So, so that's, I think you got to look at the bigger picture. Is there equity left in the property? Period. Right. That's number one. And that's super easy to figure out, as you know.
Yes,
so
absolutely.
You just take a look at what your debt is, and then you look at the value. And if you've got a nice, you might not have all the equity there that you had, but if you've got a pretty good cushion, then it's probably not a bad idea to, help that city or keep that property. But I've looked at stuff already where actually in Phoenix, that pocket listings or whatever that means, right? Yeah, we're shopping this, and you take a look, and that when you run the numbers, with the debt, the property is about worth what the loan is. So
if that,
yeah. So okay. So as an LP, what's your upside? If you're going to put money into something that isn't even worth the loan, and the writing could be on the wall, it might not be on the wall. It doesn't really, it's just every asset is just a little bit different, and every single one has a story. So like we have, I have 2 properties under construction, right? I have a 330 unit property. I started it 2 years ago because it could take 18 months, 12 to 14 months to open up the clubhouse. And then, and then the rest of the project could, you're talking about a 2-year construction. Okay. So in the beginning, you can imagine. So where are we today? It opened in July. So let's say 2021. Things were very different 2 years ago. Okay. I went to the lender, got the equity, got the debt, started building the project. Okay. I think it was, maybe 60 million, I think. Okay. So we start, let's say 40 debt, 20 equity. It doesn't really matter exactly, but you're moving along. 2 things happen. One, costs go up, interest rates go up.
Absolutely.
Okay. And, well, thankfully rents went up too, but let's just focus on the negatives. So which is kind of where everybody seems to be playing. So,
yeah.
All right. So the property, the contractors that are working on that, the roofer, the concrete guy, the landscaper, the framer, whatever, they can't perform at those numbers, period. So they're having cost overruns. Lumber's more, labor's more, whatever. So all that stuff makes its way to the cost to build it. You can fight all you want, say, oh, you said here's a contract, It doesn't really matter. It's not going to get built. They're going to walk off the job. They're not going to lose money to finish a project, period. So all that stuff made its way through. And we managed the hell out of that. And then I had a $7.5 million problem. Okay. So,
wow.
Which was, 12 or 15% or something. So actually I thought I got away pretty good. So now I have a $7.5 million problem. So that has to be funded. Okay, so my partner and I funded that to finish the project. So these are real things that are happening. When we actually got an appraisal by CBRE, and it appraised out at somewhere about in the low 90s or low to mid 90s. Okay, so we had plenty of equity there, which is why we funded it, right? So, but you got to make each decision like that, as internally, and so that's how we've done it. Is it's kind of project by project by project, but you got to take a look at, also, I don't want a black mark with a lender. It's going to affect my future, my company's future. So, what's showing up right now is experience and wisdom.
That's why you go with the operators that have been doing this a long time. Everybody in the audience, thinking about that, you really do need to interview these operators. How long have they been doing this? How many projects? How long have you been in business? I mean, you're a legend here, Ken, and you're bringing so much wisdom to the group here. If we think about the fundamentals of multifamily, right now it's difficult, right? There's so many people that are kind of scratching their head. Should I stay in this? We talk about tax benefits. We talk about, all of the concerns about our expenses going up. If we think about this nation is now changing to renters, it seems to me like the fundamentals continue and are strong. However, what's going to happen in 2 or 3 years when we've got so many projects that have not been taken down? Like a lot of these ground up construction projects are grounded. They're just not making sense. How do you vision the next, let's say, 3 to 4 years? Because 2024 to 2025, without a lot of new construction coming on, I'm thinking that the value of these assets is going to be really strong if we can make it through this difficult times. For the people that are new to this, what are your thoughts on staying focused? You might not get in a deal today, you might not buy a deal, but what's coming down the road?
Well, that's why I'm so excited. I mean that sincerely. I believe we're in the beginning, the first couple innings of what I would consider to be a very nice run for multifamily, and here's why. Well, you touched on it. When rates go up, everybody's focused on the single family housing and all that kind of stuff, or rate caps and multifamily on stuff that they own. That's fair, because those are real things. But really, what they're not focused on is the 4 projects that I stopped, because my costs, because of what I experienced on the one that I just told you about. So I put those on the shelf. I own the land, so I can just wait. And that's happening everywhere. So it's happening with single family, it's happening with multifamily. Okay, so what does that mean? That means that there's going to be a several year lag of no new supply. Okay, that's for sure. I mean, I can tell you already, all the stuff that we're seeing in the journal and all that kind of stuff, they're talking about this place is overbuilt and that place is overbuilt. That stuff is my stuff. That's the stuff we started in 2021 when rates were 3. Okay. So those are finishing, those are leasing up. Those started 3 years ago. They always do. There's a big lag with this stuff. Okay. So what's going to happen is, I think, the rest of this year and next year is going to be a real problem for a lot of operators.
Yeah.
And, because of all the debt issues and some operational issues and, some they just overpaid or whatever it is. And so that's going to make its way, out. And there'll be folks like me that come in and try to snap those up and clean them up and fix them for the lenders or whoever it is. Okay, that will all happen. That happened. I bought almost all my projects in 8, 9, and 10 directly from lenders. So there's nothing wrong with that, actually. That's the bad thing, is that there will be some losses during that period of time. But people always forget single family and multifamily could not be more different. Literally, like a person that's buying a single family house is looking at the mortgage payment. And if they can't do that, they rent. Like, it's really that simple. So what happens is when house prices go up and interest rates go up, mortgage costs go up, they're stretching, they're like, oh gosh, I can't buy a house right now. So I need to stay in a rental or move somewhere else that's more affordable, or, there's a zillion options. But the point is, there's a massive shift of people until single family starts to actually come down and rates start to come down. Right now, it's cheaper to rent than to buy. Okay. But that was not the case 2 years ago. It was, if you take a look at just look at mortgage payment to rent payment. I focus on that all the time. You want the biggest delta between the two as a landlord, as an owner, you want that to be big. Okay. That's what it is right now. So those fundamentals, along with lack of new supply that actually goes back almost, more than 10 years, you're going to see, I think, a real run in multifamily. I think you're going to see some rent growth. Again, it's actually not good for the industry. It's not good for the renter. It's supposed to be more balanced. My whole career has been a little more balanced. People rent and then they buy houses. That's the natural progression. That's not happening. Unfortunately, there's, affordable houses now, but 400 grand. It's ridiculous. So, we're supposed to have a progression of people rent and then move into houses and build wealth that way. The system's a mess. And, people are being dumped into, and we're moving into a renter nation. Yeah. And I don't know how long, I don't see any light at the end of the tunnel for it. But when you go to other countries, I'm going to Europe in a few weeks. Home ownership is really low. We've been super spoiled. We have big houses and, we have whatever, I think we're at 35% home ownership right now or something. Okay. That's not the case around the world. So, I don't know if this is where we're headed, but I would say if you own anything, keep it if you can. And I really believe we're going to go on a really nice long run, personally.
I love it. Ken, there's a lot of people new here. There's a lot of people who are trying to, do I stay committed? What is your words of wisdom for people that are just getting into this or are getting a little bit frustrated? Should they find LP opportunities and keep underwriting and keep working at this? What are your thoughts on that?
Yeah, I think people should stay local and they should start small. And it should cash flow. That's it.
Love it.
And then, the problem with investing with a company like mine or anybody really, and is that you don't oftentimes learn anything. So, it's all we've done is you've replaced us with, the wealth from a wealth manager, So I believe that you should know everything about real estate investing before you give your money to an LP. I believe you should understand it. I believe you should really understand the deal. And you should not do it on faith, just like, because otherwise, there's this big debate about wealth management and financial planning and, syndicators and all that.
Yeah.
I get it, but, what's the point? Like, if it's your money and you don't understand how, what's going on with it, you're just as much at risk. So, I think, so I always say, start small, understand the game, understand tenants, understand property management, understand cash flow, understand tax benefits, buy 1 or 2 or 3 or 4 or 5 or 6 or whatever, get in the game, get a good, don't have a 2, 3, 4, 5 year exit plan. Stay in it long term, have your tenant pay it off, and build your network, build your net worth and your network. And then, and only then, you should be in a position to invest with a GP or somebody, and then you can ask the right questions.
Yeah. Fantastic. Wonderful information. Very generous with that information, especially on your podcast and your YouTube channel. You guys, everybody should connect with Ken through those platforms. He is putting out amazing information that you might think, hey, this is real remedial. It's not. He puts the information out there so you can understand it, really, for the beginner and so forth, and up, going up. So would you mind if we opened up the room for just a
Sure.
couple
Yep.
questions?
I got a few. For real, I got a dinner with Kiyosaki in 30 minutes, but he's only about 15 minutes away. So I can do about 10, 15 minutes of questions.
Okay. All right. You're great. Jason, what's the question? I know, Jason, you love Ken. You've
Yes,
told me.
yes, I'm a big fan of Ken, so thank you so much for being here. My name is Jason. I'm a GP and a KP on a 106 unit. I'm looking to expand my portfolio during this downturn, but as you know, money is going to be very hard to get.
Mhm.
In the next 12 to 18 months. So, where would you suggest is the best place to find LPs that are going to cut you those big checks so that you could really acquire more properties?
So Jason is asking about how to find capital. It's a challenging market. Now, Ken, I know you probably have a lot of connections to get capital. What are your suggestions on finding capital for folks like Jason?
Jason, great question, by the way. Thank you. So here's my philosophy on that. I feel like everybody wants to have capital in front of them before they're comfortable in finding a deal. And I always believe that my experience has been every single time that I found a good deal, like something that's really super clear, something that's really easy to understand, that has, a before and after, and the after is more than the before, of course, a real value add deal. I actually have found that, especially on networks like this, and of course, LinkedIn, and there's a zillion other things, raising the money is actually quite simple. That's been my experience, if the deal makes sense. And I have a philosophy, Jason, which I think you like. The bigger the brochure, the worse the deal. So most deals get done on the back of a napkin. They're really simple. They're like, oh yeah, that makes complete sense to me. I'll give you an example. I have a couple guys that I own some billboards, and I like the cash flow of a billboards. So I hired a couple guys and I said, hey, go out and find some billboards. And we actually found a company that's 20 years old that has a whole bunch of billboards. Okay. It's like a 10% cash on cash, when you buy the billboard and the actual return, and this is 20 years of track record, right? So, okay. Now I've just put the thing in escrow. It's a company, it's not necessarily, a multifamily deal, but, get this. I was putting it in escrow with my attorney, and I had my CPA on the phone, and he's like, do you know that the entire company qualifies for bonus depreciation, that means I got to write it off in year one. So I'm like, are you kidding me? So all of a sudden I've got, 10% cash on cash plus 1 year write-off. Okay. Now this is the first time I've even talked about it. So, all right. Now that deal, people will invest in. I already know, you know what I mean? Because I've been banging my head against the wall for so long trying to find good deals. So that's what I mean, Jason. Like when you put a deal out like that, it gets funded. It really does. Like it's quite simple, especially with your network. You got, you got 70 people on this call. You could fund it just here, right?
We could do that for you.
Yeah. So yeah, that's what I mean by, people are smart, like LPs are
Yeah.
smart. They sniff out stuff, they see the bullshit in the underwriting and the markets and all that kind of stuff. So, as long as it's really good, I mean, and you can wow, okay, yeah, this makes sense. It gets funded.
Awesome. All right, Alan, what's your question?
Yeah, hey, thanks for showing up here, Ken. I appreciate it.
Sure.
And you like longer term holds, and so your loans are commercial loans, 5, 7, 10 years, whatever. When you refinance those loans, do you take cash out and do you distribute it to the investors, and do you dilute their equity? And how much debt do you think is a good level of debt that would be safe?
Okay, lots of questions there, but I'll handle them all. So number one is my goal is always, that's why I wore the shirt tonight, be infinite. So
Yeah,
once I can return everyone's equity and they're in the deal for 0, everything's an infinite return.
right.
So my goal is always that, Alan, 100% from day one. So if I get 10 million bucks from an investment group or whoever, they want their money back. Everybody wants their money back. So if that's what you call dilution, then yes. Now I don't dilute their ownership.
Right.
I just dilute their equity, right? So that's a big difference. So that's the first thing. And then I think that as we are long-term holders. So at that point, so the way I structure our deals is all the investor money gets paid first, and then if there's money after, I get paid. You know what I mean? So mine's always performance-based, and that's always worked really well. And so investors first, which I'm also in, right? Like on the billboard deal, my partner and I will throw $1 million each into that. So we're on the LP side too. And so, they get paid first, and then the GP gets paid second. Does that answer your question?
Yeah, it does. Now, what level of debt do you consider safe for a long-term hold when you refinance something and it's stabilized?
Yeah, so it depends on the asset and the market. So markets do change. So I'll give you an example. We were buying in Tulsa, Oklahoma for a while, and we got out of that market, which is, usually I hold, but we didn't like the market long term. We were in it for over 10. Okay, so we had like 70% debt, let's say, on it. And then the value went up still, which is good. And then we did a cash out refi, and we actually put lower on, because we're like, okay, this market, is not as robust. And so, so we've done that. Some of it depends on the rate, obviously. We have stuff under 3 that's fixed. And obviously that, now debt is an asset, right? So, so it just depends. Sometimes, like usually if, some of these refinances can happen a while later, it's best to figure out all your capital needs. So roofs, paint, whatever, interiors. But as long as you just say to the investors, hey, like we're going to take this chunk for preservation of capital. And then we're going to distribute the rest. And what they get is another value add inside of a value add that we already invested in. So we've done that a lot.
Okay. Hey, thank you.
Yeah.
Yeah. All right, Hector, we got it real quick because we have 2 more questions. So what do you got?
All right, I will keep it quick. Thanks, Julie. Ken,
Sure.
it's great to meet you finally. Long time follower, first time to get to speak with you. So this is very exciting for me. I read your book like a gazillion years ago.
Thank you.
Couple questions. Number one, what are your thoughts on BTR, build to rent, and on the Class A stuff that you're acquiring? What kind of cash on cash do you target at the project level?
So build to rent is here to stay. It's my issues with it is it's single level, so which is fine. And it's on the edge of town normally because they need, more land. So, just as a builder, we can build 200-300 units on 10 acres. They can't do that with a build to rent. They're going to have 75 units, let's say. And so, if you're going to build something, you might as well build something, if you know what I mean. So, So I think, but people love them, some of them have garages, some of them don't, they're single level, they have little yards. I think it's a heck of a great niche. We looked at it. But again, I was trying to stay in our box, we do 2-story walk up, 3-story, depending on the zoning, and very different, more infill, trying to find sites that maybe we rip down like a old grocery store or something, that kind of stuff. And you can't do build to rent there. And then on cash on cash, we're trying to hit a 7, out of the gate. That's our goal always. And it's super hard to do, to be honest. And debt is making it worse and expenses are making it worse. But that's kind of our target each time. I want to be able to produce at least that.
Yeah, sounds great.
Gotcha.
All right, Priscilla,
man.
real quick. We want to get Ken to have dinner with Robert so that Robert will come on Zoom at 8. So we got to deliver him there on time.
Yeah.
All right, Priscilla.
First of all, thank you so much for doing this for us.
Sure.
It's been 10 years since I last spoke to you. I've grown a lot, managing 65 units or 65 doors at this point. And my 2 questions for you are we are struggling to find sellers, and our buy box is between 20 and 100 units. And we've been struggling this past year to find good deals and to find good projects to invest into. And secondly, I'm specializing in asset management and was wondering if you have any suggestions or resources on me improving on my craft.
Sure. Okay. Yeah. So I don't know exactly why you're finding less sellers. Could be the number of brokers or your network or something like that. That's one area. You just want as many deal flow. You might want to maybe take a look at different markets. I know in cases where we've had that scenario. We actually, that's how we got to Dallas initially. Was Phoenix was cooked and we ended up buying in Dallas. So that is the strategy. The other thing is that's a tough size. Now, I'm not saying it's not the right size. I'm just saying that you're going to find probably a lot of money that has really low fixed rate debt in that size. And so if I'm a seller, if I've got 3% or 2.5 or 3.5 or whatever fixed on something like that, I'm probably not going to sell. But also the other thing that I found is a lot of times on that smaller stuff is a lot of times people are facing big capital gain problems. So if you can solve that problem for them, I found that I did that. I bought a resort that way. I own a resort in Sedona, Arizona. And it was the guy owned it 42 years. So you can imagine the capital gain he had. So figured it out for him. 1031, like got him an office building, even though I'm not even in that space. I actually found him a deal, found him a broker because I wanted the asset. So that was that was one way that we did it. And then on the asset management side, I think the biggest thing right now is asset preservation. So what you're going to see more than anything is, nobody was really talking about this right now, but these syndicators that are undercapitalized, think about all the things they cannot do. Okay. So they're potentially using appliances from vacancies for new, to rent units, or we used to call it cannibalizing. These are old terms that people in the business have been around a while. You're going to see deferred maintenance. You're going to see that kind of stuff. So as an asset manager, I think personally asset preservation based because of the squeeze on the expenses and possibly lower income, certainly higher expenses, and potentially even higher debt. It allows less money to be spent on a project. And and so the thing that you'll see is they'll start to fire property management companies, and then blame it on them, and then they'll bring a whole new team in, and all they're really trying to do is it's like that game with the ball under the cups, they're just moving it around. And, you know, so that's probably what I would look at for the next few years is asset preservation.
Nice.
Okay, thank you.
Ken,
Yeah.
I don't want to abuse my my thoughts here to let you go. I'd love for you to stay longer, but
I know.
I know you got to run. How would we get a hold of you, especially if we want that billboard? We want to be investors in
Oh.
that billboard deal.
Oh yeah, let me, I'll type my, oh my gosh, I can't believe I'm doing this, but I'm going to.
Yes, I think there
Wow.
might be some opportunity for 68 people now in the audience. We might want to get you
Yeah,
some
so that's
investors.
my email. Now, don't be offended if I don't get back to you right away. I got a ton coming in all the time. So that's how you get a hold of me. That deal will not be out until probably mid-October. So
Okay.
realistically, we're in due diligence. We just got all the stuff on Dropbox this week. I still have to go out and physically look at all the boards and all that kind of stuff.
Yeah.
But yep.
Well, Ken, thank you. I can't be more happy than our time together. I really appreciate you saying yes and being with our audience tonight. If there's
Happy to
anything that
help.
we
Hey,
can be doing,
good luck to you
appreciate it.
guys. And as always, Julianne, thank you so much for having me. I wish you all the best.
Thank you so much. Have a great
Okay.
night.